Hello and welcome to the show. I'm Kim Parlee. For those of you who are watching this in replay, yes, there is a game on right now. And of course it is, I think, 6-3, bottom of the 7th. And if you just stay here and watch us, I promise we'll give you an update on the score as it goes. That's how I got Dave here. David Sykes is joining us right now, and he's only here because we're going to keep track of what's actually going on with the game, right?
Exactly.
Okay, there you go. So let's talk a bit about the markets, though, and what's been going on. And we've actually had, of course, the S&P index has had quite a run until August, and then we saw markets sell off and fell over 10%. The markets have recovered about half their losses since that time, but the volatility really still does continue. And today, Walmart closed down 10% after the company warned of lower earnings, dragging the broader index down. So just where the markets are headed, what's happening with earnings, and what can we find out from David. David is David Sykes. David is David Sykes, lead manager of the TD North American Dividend Fund and head of the fundamental equity team at TD Asset Management. You can just sit there and giggle as I boot. Everything I say right now is fine.
I like your hat.
Thank you very much. I like it too. I'm going to hang on to it for a while. Let's start with the earnings numbers. And you know, Walmart, after hours today, Netflix came out and had some pretty bad earnings. And I think going into this earnings season, there's been some apprehension in terms of what's going to happen. So, is that reflective of what we're going to see?
Well, let's just talk about the two specific cases you mentioned.
Okay.
So if we look at Walmart first, what happened today was Walmart came out and said that our profits next year will be 9 to 12% lower than expectations. That's a pretty big deal for a pretty big company that matters. Now, I think the specifics, though, are that Walmart is going to be raising compensation, hourly wages for its workforce. That's going to cost them another $1.5 billion. And they have to do some big investing in their online e-commerce business as well. So they're making investments in the company for the longer term, but that is going to hurt earnings in the shorter term. And if you look at Netflix, after hours, they reported they had a domestic subscriber number that wasn't quite as high as people thought. Expectations in that stock are through the roof. So I wouldn't extrapolate too much for the broad market from those two stocks.
Okay.
But I would say in general, coming into earnings season, it's a very similar pattern to what we saw in the first and second quarter. Expectations were high. 3 months ago, though, those expectations started to be ratcheted down. So 3 months ago, as an example, people thought that earnings for the S&P 500 year over year would be up 4 or 5%. Now expectations are for down 3%. So expectations have come down a lot. And I think what you've seen so far in the earnings season, whether it's Wells Fargo, Johnson & Johnson, Intel, companies are doing less worse than people thought. So it's not a blow-away earnings season, but I would say expectations are low, and it's not going to be a very high hurdle to beat those expectations.
But couple that with, I guess, valuations, which have come down. I mean, we've had, you know, I mentioned a bit of a rally to pick up half the loss, that big sell-off that we had. But when you compare valuations with what we're getting from companies and earnings, are those valuations justified?
Yeah, I would certainly say that the sell-off you saw in August was really about, people talked about China, and that was part of it, but it's really this global growth scare.
Yeah.
And so the question you're fundamentally asking, is the S&P, is the market fairly valued at 16.5 or 17 times earnings, given a pretty bleak global growth outlook? And I think the answer is yes, rates are very low. Where else are you going to go but equities? But I would say what you're going to see with questions about global growth, questions about productivity, questions about U.S. growth, you're going to see much more volatility. And so my message would be, with that volatility, if there's ever a time to focus on quality and quality stocks, it's now. There's a lot of questions out there.
And with the quality piece, though, I mean, you know, Walmart, as an example, blue chip company, I mean, steady as she goes, selling off 10% in one day. I mean, that's kind of something that I don't think people would expect.
That's true. I mean, it's a very big company. It's a $200 billion market cap. Now, one of the issues with Walmart is it's really big.
Yeah.
So they sell almost $500 billion a year of stuff.
Yeah.
So growth for that company is difficult. But I would also remind you, Walmart has a really strong balance sheet. They're going to buy back $20 billion of stock. That's about 10% of their float. The dividend yield now over 3%. You're not going to get 20% earnings growth here, but once they reinvest in the company, if you can get through 2016, they're looking at growth rates in 2017, 18, and beyond of 3-4%. Doesn't sound great, but if you combine 3 or 4% earnings growth with a 3% dividend yield and probably a flat multiple, that stock now trades at 14 times forward earnings. I think that's a reasonable expectation. It's probably similar to the market overall. People shouldn't be expecting 8s and 10s and 12s in terms of year-over-year gains in stocks. I think you're looking at 4s, 5s, and 6s.
On top of that, and we're kind of backing into this, but in terms of what the Fed is going to do and the impact on markets, the Fed has, again, you know, cited, I don't think we've talked actually since the last time the Fed made an announcement, China's an issue, or the global growth is an issue. Are we still in a lower rates for longer is good news for equities, or are we more in the camp of lower rates for longer means lower growth, therefore not good news for equities?
Yeah, I think certainly the Fed surprised the market a little bit in September when they didn't raise rates.
Right.
So now the debate is, do they go in December of this year or do they go in March of 2016?
Right.
It looks like the market's expecting March of next year, but it's a close call. But I think the point is that rates, when they rise, and I do believe they will go up 25 basis points in the next 6 months, I think that's a good sign. It's something the market needs. I think we're now getting to this global growth picture. You think about China, you think about low productivity, the demographic profile, you think of the high debt loads at the consumer and country level globally. You need to start to see higher rates because that means things are getting better. I'm okay with a 10-year treasury that's at 2% or 2.2%. I don't want to see that go to 1%. So I think higher rates actually does mean better things for stocks ahead.
All right, stay with us. When we come back, we're going to have more with David Sykes. He is lead manager for TD North American Dividend Fund, head of the fundamental equity team at TD Asset Management. We'll be talking the Canadian dollar. We'll also be talking some specific stocks that he is liking right now. So any comments or questions, we do love to hear from you. Send them to moneytalk@bnn.ca so we can answer them for you on the show, or find the right person to answer them for you later. More Money Talk when we come back. We are back with David Sykes. He is lead manager for the TD North American Fund. You hold U.S. stocks in the fund, and which has benefited from a depreciating loonie. Although obviously you're a little more sophisticated than the average investor. But for a lot of Canadian investors who have been unhedged and in U.S. stocks, the currency play alone has been fantastic. What is your call, or what do you think when you look at the loonie over the next little while? What's going to happen? Right.
So specifically, I look at the Canadian dollar versus the U.S. dollar, and for me, that has been a great source for returns because I have U.S. dollar assets, and as that Canadian dollar depreciates, you get a double whammy, if you will, because not only does the stock price go up, but you get the currency as well. Now, sitting about 77, 78 cents, I think the big question you have to ask yourself if you're going to be bullish or bearish on the loonie is, where are expectations for short-term interest rate differentials? That's a fancy way of saying, do you think the U.S. is going to outperform Canada from a growth perspective, or do you think Canada is going to do better for the economy, for income, for jobs? And where I sit right now is I think that we're about right. We probably could maybe go to 80 cents. I think a lot of this is going to depend on oil as well. If you see WTI, if you see the Saudis decide to cut back production, or you see U.S. producers really curtail their production, I think you could see a higher WTI price, which means a higher loonie. But I wouldn't be looking to going anywhere back to parity or 90 cents anytime soon. I think it's going to be some tough sledding in Canada for a while, and I think probably 77 cents to 80 cents or 82 cents is about the right range.
So this is going to be about more stock picking than it is about currency. I'm just we're not going to get that.
I absolutely believe so. I think the currency move has really helped, but I think it's done for now. And if anything, I think the Fed goes before the Bank of Canada, which probably means a stronger U.S. dollar and a weaker loonie.
Okay. Let's talk specifics. People love to hear this right now. So when you are, and again, let's talk U.S. stocks tonight. When you're looking at U.S. stocks, who's on your radar? What's interesting right now in this environment?
Right. So I talked a lot tonight about growth, but really a lack of growth.
Right.
So what I'm looking for are companies that can grow a little bit faster than those 4 to 6% earnings growth expectations that I'm talking about. So one of the stocks that I like a lot is Medtronic. Medtronic is a device maker. It does cardiac rhythm management. So pacemakers, a lot of people have those. If your heart beats too slowly, you have a pacemaker. It's also something called an ICD, an implantable cardiac defibrillator. If your heart beats too fast, they shock it and they can get it to beat normally. They also have some diabetes products. They've got some spine products. They've recently made a great acquisition of another company called Covidien. This is a healthcare stalwart. It's $100 billion market cap, $28 billion in sales. They have paid and grown a dividend every year for 38 years in a row. And I think this is a company that can grow its earnings next year by 10%. It's got a 2% dividend yield currently, but tack on that 10% earnings growth, and it's one I quite like. Again, it fits all of my metrics. It's got great competitive advantage. It's got a strong balance sheet. They produce tons of free cash flow, and they really reward investors with that increasing dividend.
What about, and I know this isn't so much, I think, for medical device makers, but with the Democrats, going through what they're doing right now, lots of chatter about drug prices and healthcare in general. Where does Medtronic fit into all of that?
So that's definitely a concern. One of the risks for the stock is pricing. Will hospitals pay the rates they've been paying for these devices? And I think one of the things that people forget about the ACA, the Affordable Care Act, also known as Obamacare, has been a pretty big boon for the industry because more and more people now have access to these therapies because the government will pay for the insurance. One of the questions that you have to ask yourself is, this industry isn't 10, 15, 20 players. It's 3 or 4 players. It's a nice oligopoly. There's a defensible position there. But definitely there could be some impact on pricing. But I think the volume increases you're going to see, you think about the demographic profile,
people getting older,
age of America,
more affordable.
I mean, I think everybody knows someone who's had a pacemaker or a defibrillator implanted. And I think that trend will more than offset the price concerns.
Okay, number 2, Tiffany's.
Yeah, Tiffany's. So ticker TIF. It's a slightly different one for me in that it's a little bit smaller market cap. It's about 12 billion. Tiffany's really, the competitive advantage here is that iconic blue box. I mean, these folks are great at designing jewelry. They manufacture fantastic quality jewelry. They have, again, that box, that competitive advantage. People want those products. Another really great balance sheet. And the thing that I like about Tiffany's is they only have 300 stores today globally. And I know we've talked about slowdown in China, but don't forget, what's happening in China is there's a shift between investment spending and infrastructure more to consumption spending. And that shift's going to continue. And I think you're going to see Tiffany's continue to expand and grow in emerging markets in China. I think you're going to get 3-4% same-store sales growth combined with new store openings. So I think you're looking at a stock that can produce 10-12% earnings. They have increased the dividend now 13 years in a row. It's a 2% yielder, but they've grown at 12% on average over the last 5 years, and it's one that I like quite a bit. They do have a new management team. The price of gold and silver's come down. That should help their input costs, mean expanding margins. They now have some new innovative marketing, some great new lines of jewelry they're coming out with. About a third of the sales are at Christmas time, so expect bigger numbers soon. They report in a few weeks. The multiples come down a lot. This used to be a stock well over $100. It's now $78 or $79. They're going to report in a few weeks. I'm going to keep my eye on those numbers, but it's a stock that I'd like today. If it happens to get weaker in the future, I would definitely add to my position. And
you have no excuse now not to buy someone you care about stuff in Tiffany's if you own the stock. So what about and this is a data point, but I know I saw, I think, the latest China trade numbers that came out, I think, a couple of days ago. I think it was like exports were down 3%, but imports were down 20% for the 11th consecutive quarter. Does this, I know that's not Tiffany's, but at the same time, it's about what they're buying. And
it's absolutely a concern. I mean, this is the issue. If you think about the global economy, the U.S. is maybe growing 2-2.5%, which is okay. It's not great. Europe's in a whole heap of trouble, and Japan is not exactly firing on all cylinders. So the one engine of growth was China. And so the question is, this economy is not growing at 10%. It's probably not even growing at 7%. But is it growing at 5 or 3? And are we going to see a massive fiscal stimulus from the government to try and pull us out of this? Or is this really a hard landing in China? I think we expect that it's going to be a slowdown. And I think that then is going to mean a slower global recovery. It's going to mean slower earnings growth for corporations. And you really need to focus on quality and the dividend, because that's going to be a bigger and bigger source of your return going forward. Okay, I think we're going to leave it there. I only have one last question for you. Score 6-3 for the Jays. Remember, this is going into a replay. This is going to play later on. What's your prediction? Who's going to win? Blue Jays win. All right, there you go. David Sykes, lead manager for TD North American Dividend Fund, head of the fundamental equity team for TD Asset Management.